Now let's talk about the global trade war. Europe has opened higher this Friday, even as Asia turned out to be a mixed bag. Remember, the tariffs officially coming into play from the US and China. And here's Michael Every, the head of financial markets of research at Rabobank International, now joining us. Thanks, Michael, for joining us here. So Asian markets were a mixed lot. However, you are seeing the European equities open slightly higher. The tariffs are coming into play. Is the largest trade war as defined by China, and a lot of activity that's coming out of Europe as well. ThyssenKrupp chief offering to resign. How are you guys managing all of this volatility? Are we seeing a case for maybe exposure to equities being reduced and all that money flowing into commodities, or the other way around?
I don't think there's a good argument for being in either equities or commodities if we're actually going to see a global trade war. Obviously, all we've had today is the first bullet fired, and one bullet is not a war make. But if you believe that it's only going to be one bullet, then perhaps you might want to think, well, both commodities and equities look cheap at this valuation. Having said that, if you think that there's a lot more to come and that one bullet will be followed by many, I cannot see a logical reason why you would buy either.
Right, Michael, I just wanted to understand about the outflow that's happening in the emerging markets. Have you been tracking that? Why do you think such a risk of sentiment has happened suddenly?
Well, I mean, there are various different factors. Obviously, one is the fact that the Fed is continuing to tighten, and they're still looking at, several more rate hikes ahead over the next 12 to 18 months. With the US yield curve already pretty flat, 2/10s down now to about 28 basis points. We're already getting a warning signal that the Fed may be doing too much. That's never really positive for emerging markets, both in terms of a stronger dollar and the risks to the US economy should anything go wrong. But above and beyond that, of course, the trade war is negative for just about every emerging market in Asia because they're all net exporters to the US one way or another. So you put those two factors together and you really have to be extremely optimistic to find a generalized reason to dive in and buy emerging markets at the moment, regardless of how cheap you may think valuations look.
So, Michael, then tell me, if you're seeing this outflow that is coming out from the emerging markets, thanks to these global triggers, you've already touched upon the FOMC. Look at the way the dollar has been behaving. You've got the Dow futures up 200 points. You've got crude, which is selling off. So where is all this money going?
Well, I would think sensible money is just going into cash, to be honest. Having said that, you can also see that some of it's still going into treasuries because yields are still pretty low. But you can also see that some of it appears to be going into developed market equities, and I don't see the argument there either, to be honest. I don't think there's any more reason to buy developed market equities than there are to buy emerging markets if we're going to see a global trade war, unless you buy very, very selectively and buy firms that are exposed to the local market only and which produce at home and which will do better without Asian export competition. So, you're talking about the equivalent of the Russell 2000 in the US rather, than the S&P or the Dow. So if you're going to take that particular attitude, then maybe there is some value. But apart from that, on a generalized basis, again, I don't see it.
Okay, so we're going to leave it at that, Michael. Thanks so much for joining us here to make us understand this. Is the first salvo when it comes to this trade war, the deadline for the first set of tariffs. Asian markets mixed, European markets have opened higher this Friday. With that, we're going to take a short commercial break, but stay tuned. You're watching Markets Alone.